What's up everybody, I am Jaspreet Singh and the housing market is showing its first signs of cooling down because mortgage applications have been dropping as mortgage interest rates have been skyrocketing even though we're still facing a massive inventory shortage of homes. The reason why this is especially interesting is because we know that the Fed wanted to raise interest rates as a way to cool down inflation, but we never expected the Fed to come out and say that they wanted to cool down the housing market or potentially cause the housing market slowdown. But now the Fed is saying the opposite because now we have Fed officials coming out and publicly stating that they want to cool down the housing market. Essentially what the Fed is saying that because of the high inflation, because of the high gas prices, because of the high housing costs, we need to prepare because now the Fed is going to get more aggressive in raising interest rates, and they are saying openly that we can expect a shift in the housing market in the future. Now you already know that I like looking at history to get an idea of what might be coming in the future, and we've seen something like this happen in the past. After the 1991 recession, the Fed started raising interest rates just like we're seeing happen now in 1994, and that caused a big shift in the housing market. 1994 was the last time that we saw interest rates rise as fast as we're seeing them rise right now. And what happened was the Fed raised their interest rates from around 3% to 5.5% over the year 1994. This brought mortgage rates up, so I'm going to draw this as a home right here. Mortgage rates went up from right around 7% to just over 9% in the year 1994, and this caused home sales, so I'll label this sales, to drop by 20% in the year 1994. I'm going to diagram what's going on in 2022 with this blue marker because in 2022 the Fed's goal is to bring interest rates up to around 3%, and we started at right around 0% to 0.25%, but the goal is to get it up to around 3% for the Fed's interest rates. And remember, the interest rate that the Fed is talking about is different than the interest rate you pay when you get a mortgage, because we saw mortgage rates go up. I'm going to put this right here, there's not much space over there, go from around 2.5% to 3%, and now we're already at about 5%, and we have just started seeing the rate hikes in the Federal Reserve Bank. The Fed says that we might see another 5 or 6 rate hikes in 2022. So we can expect to see a number of more Fed rate hikes happen in 2022 because we still have quite a bit of way to get to this 3% target number that we're seeing right now by the Federal Reserve Bank, which could impact where mortgage rates go because we're already at 5% mortgage rates. And home sales are now just starting to cool down. So we'll see where this goes because we've seen projections of economists and real estate people saying that they expect home sales to drop. Now, this shouldn't come at too much of a surprise because the cost of home ownership has been growing at the fastest rate really ever. Like if we look at this home in 2021, it might have cost $500,000. If you put down 20% in 2021, that means you'd put down $100,000 for your down payment, and then you would go and finance the other $400,000, and you could get a mortgage for right around 2.5% in May of 2021. Now, at a 2.5% mortgage for $400,000, your monthly payment would be right around $1,600 a month. So $1,600 a month and $100,000 down. Well, now in May of 2022, the home price has gone up. Let me actually put this in blue so it's easier to read. The home price has gone up to $600,000 because home prices have grown by around 20% over the last year. Now, if you want to put down the same 20%, that means you're going to need $120,000 down payment, and then you're going to finance the other $480,000. Now, you're not going to get it at 2.5%. You're going to have to finance it at 5%, which means now your monthly cost is also going to go up from $1,600 to about $2,600 a month. So your down payment is 20% more now, and your monthly payment is more than 50% more now. So the cost of home ownership has gone up more than just the 20% of the home. It's the extra 60% or so in this monthly payment that you're paying. This is where people are getting sticker shock and they're turning around saying either we'll buy smaller, we'll continue to rent, or we'll continue to live where we are right now. This is where you have a lot of people starting to worry about a potential housing market crash and what's going to happen to home prices. But there's a difference between a home price cool down and a housing price crash, which let me demonstrate right here. So up until now, this is a very rudimentary chart. Home prices have been growing pretty much like this. Now, home price cool down, I'll put this in my blue marker, would look more like that, where home prices are still rising, but not as fast as they were before. A home price crash would look like this, where home prices are going down from where they were before. Right now, economists and experts are saying that we're going to see this, a housing price cool down. In order to see this, you have to look at the broader economy, which means jobs. And right now our economy is in a weird place because many people predict that we could be seeing a recession sometime by 2023 because our economy has been slowing down. And the reason why our economy has been slowing down is because of, well, inflation. The cost of everything has gone up so much, from your groceries to your vacation to your housing cost to your car to really anything else. The cost of living has gone up so much faster than wages that people just can't spend as much money as they could have before. Now, this is a really weird thing because at the same time here are all these companies making record-breaking profits. But what these record-breaking profits don't show you is the number of units sold. The reason why so many companies have higher revenues and higher profits on paper, or at least at the dollar amount, is because they have to charge more money per item. But they're not necessarily selling more stuff. So the reason why their profit number and their revenue number looks higher is because they're selling more units of a higher priced product because inflation has caused the price of everything to go up. But that doesn't necessarily mean that they're making more money because they're not necessarily selling more units. For you to be making more money today than a year ago, and by money I mean actual wealth, not just the number of dollars that you have, you'd have to be making about 10% more money today than you were a year ago because you have inflation at around 8.5%. Now, of course, this inflation number is just the reported number. The real inflation that so many people are facing is significantly higher than 8.5%, but you have to be making at least 8.5% more money today than you were a year ago. So if a company is reporting profits of 6% more today than they were a year ago, it might look like a record-breaking profit, but relative to inflation, it's actually a loss. The reason why the economy is so important to look at when it comes to the housing market is because the economy is what provides jobs, and jobs is what provides people incomes to pay for their rent and their mortgage costs. Now, we know already that we've had a lot of institutions buying up homes across the country, and so even though people haven't been able to afford homes like they could before, homes are still being bought, whether it's by a person or an institution. The concern that everybody has about the economy, which would ultimately lead to the housing market, is if we're entering a point where the cost of homes are going up and mortgage costs are going up, making housing affordability go down because now it's so much more expensive for people to buy homes, while the economy is going down because now if we see a slowing economy, that means we could see more potential layoffs, which means we could see more people potentially not have an income to pay for their housing costs or their mortgage costs or their rent costs. Now we would start to have a problem because not only could we see a potential housing market cool down, but we could see home prices go down because now people cannot support their rent, they cannot support their mortgages. This is the part that we don't have an answer to yet because we don't know what's going to happen to the economy for sure. We have lots of people predicting a potential recession, and then we have some people that are saying that we're not going to see a recession. So let's pay attention to that. But now to supplement this higher cost of home ownership, people have been turning to a different kind of mortgage. Now, this isn't a new type of mortgage because we've seen these type of mortgages before, and they are known as adjustable rate mortgages, ARMs. Now, I just have to say this very bluntly. This is probably one of the worst times ever to be getting an adjustable rate mortgage, because an adjustable rate mortgage is a mortgage where the mortgage rate adjusts. If you go out and get an adjustable rate mortgage, you're going to get a low teaser rate for the first few years. So if you go out and get a adjustable rate mortgage, yeah, for the first few years, you're going to have a low mortgage rate, but then it's going to adjust. And if the Fed stays true to their word of raising interest rates significantly, that means that you can expect mortgage rates to be more expensive when it adjusts than what it is right now. So if mortgage rates adjust and then you have a much higher mortgage rate than what you're paying right now, that could put you into a tough situation because now all of a sudden mortgage rates go up, your monthly payment goes up, and if your income isn't going up fast enough to support the higher interest rates, then you can be in big trouble. We saw that happen after the 2008 crash because so many people had adjustable rate mortgages that they were getting because it offered a low teaser rate, and then interest rates went up and people were not able to support the higher mortgage costs. So please be aware of that and take these adjustable rate mortgages with extreme extreme caution. This brings me to the topic of I bonds, which has been gaining in popularity a lot recently. But before I talk about I bonds, I do want to mention that if you're interested in staying up to date in what's happening in the top finance and business world like this, you can check out our free newsletter called Market Briefs. Market Briefs is a free finance and business newsletter that I created where every day our team is working to break down what's happening in the world, in the financial and business world, in a fun and easy to read newsletter. You can read the newsletter in less than 5 minutes every morning, and I can promise you it is going to be an email that you're going to want to wake up and read every single morning. So if you want to check out Market Briefs, it's completely free. I'll put the link to how you can do that down in the description below. A bond is a loan, and a treasury bond is a loan that you make the government. So if you go out and you buy a treasury bond, you are loaning the government money, and they're going to pay you interest in return for your money. But now there's a new type of treasury bond that has been growing in popularity quite a bit, and that's called the I bond. An I bond is an investment that you can potentially make where the government will pay you back an interest rate depending on what inflation is. So essentially, the higher inflation that we see, the higher interest that you get paid. And right now, at the time of me recording this video, these I bonds are paying out an interest of 9.62%, and that's going to continue through October of 2022. Now, there's a few things that I want to mention about I bonds because many people have been looking at them as a solution to invest your money or grow your money in a way that's going to beat or at least match inflation. That way you can grow your money and then potentially use this money to maybe buy real estate or a home if that's what you wanted to do. So an I bond is a way for you to invest your money, but you have to understand that this 9.62% is not the return that you might see for the whole 5 years or however many years you invest your money into your I bond. The interest rate on your I bond is going to adjust 2 times a year, and the factor that it's going to look at is, of course, inflation. If inflation is rising, the interest rate that you get from I bond is going to go up. If inflation is falling, then the interest rate that you get would go down. Second, there's a cap to how much money you can invest into an I bond, and right now that's $10,000 a year. Third, I bonds are not super liquid because the way they work is it's going to pay you interest over the next 30 years. Now, you are not required to keep your money into the I bond for all 30 years, but if you cash your money out before year 5, there's going to be penalties associated with that. So typically, you're going to have to keep your money in it for at least 5 years if you want to avoid all the penalties. The risk with an I bond is that your success is tied to the health of the United States dollar and the United States government. This is why treasury bonds are considered to be very low risk, because the hope is that we're not going to see the United States government default and that we're not going to see the United States dollar default. So because of that, they're considered to be safer investments, but that's where your risk is tied because you're going to be paid in United States dollar. You don't own any hard assets. You don't own like a physical thing like you do with real estate, but you get paid with this interest. And so, you know, the more inflation that we see, the higher interest that you can get. Now, if you're interested in buying an I bond, you can go to treasurydirect.gov to purchase some. So if you've been thinking about buying a home, but you feel like you're getting priced out of the market, the thing that you need to be aware of is what can you do right now to improve your finances, that way you can afford a home, because the last thing that you want to do is go out and stretch yourself too thin just so you can be a homeowner, and then you're living paycheck to paycheck and you have no more money left over for your savings and for investments to build you wealth. So what you don't want to do is do that, which is why if you want to continue to build your wealth, you need to be aware of what's happening and use your money in a way that's going to continue to benefit you. You find alternative investments, that way you can grow your money, and maybe you work to earn more money, that way you can have more money to buy the home that you want and actually be able to afford it. If you enjoyed this video and you want to see how much worse housing affordability is going to be, I made a video covering it and you can watch it by clicking that button right over there. Thank you for watching, and as always, keep hustling. 60% from $1,645 to $2,684 a month, and that's not including the higher property taxes that you're also going to have to pay, because now your property taxes are going to go up